Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by investment strategist Ryan Grabinski to talk all things markets and the economy. Ryan, how are you doing today?
I'm doing well. How are you?
I'm doing really well. Thanks so much for asking. I want to kind of do a bit of a grab bag with you today, but let's start with the market gauge, which is an exercise that you all do where you categorize 16 building blocks of the market into favorable or unfavorable. The gauge has shifted further unfavorable as you downgraded liquidity in its most recent iteration. So I wondered if you could talk about what went into that downgrade and then maybe more broadly put into context what it means for the gauge to be unfavorable, what that says about the economic environment.
Sure, absolutely. We could. That's a great place to start. So obviously, we downgraded liquidity in our the market gauge. As you mentioned, the latest reading is at -6. Just for the overall context, this is typically a reading that we see when we are in more recessionary periods, or those where we're starting to see this economic slowdown, such as the one that we're in right now. I think as far as the downgrade of liquidity goes, I think one of the major impetuses for the downgrade was actually, if we look at just M2 growth on a year-over-year basis, it's off significantly from the highs. Last month it was at 4.1% on a year-over-year basis. This month the reading is even lower. It dipped below 3% on a year-over-year basis, and this is now the second consecutive month-over-month decline in M2. I think if you just kind of think about it from a market standpoint a little more, one of the largest buyers of treasuries, the Fed, is actually also coming out of the market, and so that's going to create some liquidity concerns. And then if you think about the equity side a little bit, one of the biggest buyers of equities over the last call it decade has actually been corporations themselves, and to the extent to which interest rates are rising, and they're going to have to be a greater focus on debt repayment, and buybacks may actually start to slow, or the pace of buybacks may actually start to slow here. So I think combining those three things is sort of the impetus for our downgrade of liquidity.
I think that makes a ton of sense. I mean, you mentioned M2 money growth. There's generally just less dollars, less liquidity in the system, which is probably a positive for inflation, but not necessarily a positive for risk assets like stocks. So let's shift. You mentioned how difficult things are getting for corporate operators, higher interest rates, less liquidity. We are in the middle of an earnings season right now, and while there's still a lot of companies yet to report, I'd like to get your take, kind of midway through this thing, and what are companies saying, and what are their outlooks for the future as we move forward into a new year?
Yep, certainly. So, if you asked me this question last week, I would have said that earnings are coming in a little better than expected. I think just seeing where things are falling this week, we're starting to finally see that decline in earnings that we've been expecting for quite some time. Some of the largest constituents in the S&P 500 have reported this week. Obviously, they've had softer outlooks for next year, which is something that we've sort of been expecting. We're starting to see that play out for the time being. I think the big takeaway right here is that we still believe that earnings estimates have to come down for 2023. They had been as high as 252. They're back to the latest reading was actually below 237. So we're starting to see that decline. Our own estimate is for something closer to the $200 level. So we still think there's more to go, and we're starting to even see that when you listen to some of what the companies are telling you. They're starting to say, hey, we're actually not going to provide guidance for next year. We think the demand picture is softening, and we're not exactly sure where things are going to play out. So I think we're sort of still in the early stages of that earnings decline that we've kind of been expecting, but we're starting to see the consensus come around to our view.
Right. And a lot of the things that you mentioned, lower demand, higher interest rates, things that are challenging companies' bottom lines are in large part engineered by the Federal Reserve in their battle to fight inflation. And so let's turn to that. We get a Fed meeting in early November, the second to last one of the year. What are you all expecting from that meeting? And then if I could ask what you're expecting going forward, because right now the equity market is really honed in on this idea of when is the Fed going to pivot to easier policy or at least to a slower path of rate hikes. What are you all expecting as we head forward?
Certainly, the Fed pivot is all the talk these days. With the meeting that's coming up in early November, we're still expecting a 75 basis point hike. The meeting for December, our base case is for a 50 basis point hike, and at the end of the day, the market may view that as bullish. But I'm not sure that's going to necessarily be the case. I think the Fed is still tightening. 75 basis points is a rapid pace. 50 basis points is even a rapid pace. But the Fed and the Fed is still on course. We haven't really gotten inflation under control yet, right? The inflation nowcasting that the Cleveland Fed publishes is expected to be 8.1% for October. So these are certainly still elevated readings that we're getting. I think there's still more work to be done. And at the end of the day, the labor market remains strong. And as long as that's the case, then the Fed is going to have the cover to continue raising rates.
Yeah, it's hard to pivot to easier policy when inflation is still running above 8%. Which is obviously a historically very elevated level. So, Ryan, it gives us a lot to watch next week and into year end. We always appreciate the time, the insight, and hopefully we'll get to chat with you again soon. Have a great rest of your day.
Absolutely, Ross. Thanks.